The buy side community are people like Fidelity and Capital and T Rowe and Ron Barron and Kathy Wood ourselves. Let's start with the sell side. So I'm more bullish than most of the sell side analysts. My price target is higher, and my estimates are higher. So just as an example,
If you're an investor in Tesla, you'd probably want to know who owns the stock, who's buying, and who isn't. Surprisingly, at this time, there's equal ownership between retail investors and institutional investors, both at 43% ownership, and the remaining 14% by Tesla insiders, with Elon Musk owning 13%. With 43% institutional ownership, Tesla's gaining favor amongst the big guns. In July, Vanguard bought an additional 2 million more shares as they continue to accumulate each month. They now own 8% of the company. Luckily for us, there's a handful of portfolio managers who has worked at these firms in the past and who is now regularly part of the Tesla community. Today, we get to talk one-on-one with Gary Black. Gary Black is the managing partner and co-founder of the Future Fund, an investment advisory firm focused on investing in growth equities of companies that are changing the world. Gary has extensive experience spanning nearly 30 years, having been CEO at Aegon Asset Management, overseeing $120 billion in assets, CEO at Black Capital and Janus Capital Group, and CIO at Goldman Sachs. Check out the Future Funds ETFs when you can. Their new fund, Future Fund LS, FFLS, trades on the New York Stock Exchange long-short fund, which we'll discuss a little bit more later. Welcome, Gary. I know you'll be able to help me get brighter. Thank you for joining me.
hi, Herbert. Good to see you.
Fantastic. Thank you, Gary. So you're quite well known in the Tesla Twitter community, the X community now. And also you are regularly on many shows, including CNBC quite a bit. So why don't we start with the bat? I don't know if people have actually heard your story. How did you discover Tesla very early on? You really are a Tesla bull, although you're more of a realistic bull. But you represent Tesla in many ways to the institutional firms that are out there. You're still very much in contact with them, but also you represent them to, again, on TV and so forth. So how did you discover this? Because as we know, many institutions were very reluctant to get to Tesla early on.
So you're right. We're very bullish about Tesla. It's our second largest position in both FFND, which is our long only portfolio, and FFLS, which is our long short portfolio. And we still think there's a lot of upside, even though it's run a lot this year. The way I got started in Tesla, I was in Miami, and I can't remember why. I think it was at some conference, and I went into the Tesla store because there's a lot of talk about it. This was in 2019. This was in, I want to say August. And I decided to take a test drive, and I was just floored. As the thing. I took it out of the store, and it just like took off. And I was like, wow, this thing is very fast. I had a Porsche Cayenne at the time. I've always been a Porsche owner. I had a lot of 911s. I had a Cayenne at the time, Cayenne Turbo. And I was just amazed by how quick it was and how it just felt so advanced compared to Porsche. And I loved my Porsche. And so after I got back, I came back to my office. I built a model, and that's what the analysts do. And I tried to figure out, okay, it's not making money today, but
Mm.
I knew that people were buying more EVs, and that EV adoption, which was tiny in the US, was probably 2 or 3% at the time, was going to go higher because I felt like, climate sustainability was a trend that, people were paying attention to. And so I built a model, and lo and behold, I came up with it. Tesla actually looked pretty cheap, even though it wasn't making money, because if I could say, okay, EV adoption was going to go from 2% to, now you think about it globally, and I was thinking 30% at the time, and Tesla was going to capture a certain share of that EV business. And you could look at what it was charging, average selling price, what its margins could be over time as it got bigger. It could actually generate a lot of earnings as you get out 4 or 5 years. And so I came up with a model, came up with an earnings number, and put a multiple on it. At the time, Tesla was trading at an infinite multiple because it wasn't making any money. And then I discounted back, and I said, wow, at the time stock was about $15 a share. This is, everything after the split adjusted, because it's split, 15 to 1 since then. And I bought the stock, and I just, I've been long almost the entire time since that time. except for one brief period. I think it was 2021
Right.
when Elon decided he would
Bitcoin.
buy Bitcoin, and they wouldn't provide any guidance. And so I got out of the stock. Um, and this is, I can't remember the exact price, but it was, I want to say it was like 850. This is all, it was after one split, because I remember it split 5 for 1 in 2020, so let's call it 150. And then it dropped to about 600. And then I got back in because I thought, okay, they weren't going to buy any more Bitcoin. A couple months had passed. And I didn't like that they were buying Bitcoin because, one, I just don't think Bitcoin has much value. Two, that's not, to me, as an institutional manager, you don't spend cash buying Bitcoin. You either give the cash back or you just keep it as cash. So that was why I got out. Then I got back in once the stock dropped, and we've been long ever since. That's the story of how I got it.
No, fantastic. So yeah, you actually saw the product, which is great, right? You actually saw the product and then you were bold enough to buy 2019. When was this? After the whole, debacle of Tesla's about to go bankrupt, the Model
It was
3,
actually during it, Herbert. 2019 was kind of a wacky year. There was a lot of talk. They weren't, I think 2018 was probably the worst year.
right?
And then even still 2019, there were a lot of Tesla Q people, and the short interest was very high. And when I'm looking for a long
That's right.
position, I like seeing high short interest because that means, if they can beat, they can really, the stocks can explode. And it's something you got to be careful
Gotcha.
on the short side. But I think there's an opportunity out there to just have a collection of high interest longs. Take the universe of any stock with short interest above 10% at the time. Tesla was way above that, and just find the ones with the best fundamentals and put that into a portfolio. But I just thought that, and I used to engage. This is back again, August, September, October of 2019. Once I bought my shares, I started engaging with a lot of the shorts. So David Einhorn and I had a very, I don't want to call it strange relationship, but we were engaged with each other and we talked to each other a lot. And the same thing with Chanos and a couple of other folks that are
Mhm.
still there. And I just wanted to see, as an institution, what they got, what kind of bullets they had, what made them so convinced that Tesla was going to go to zero. And I couldn't get there. I didn't really saw what they saw. And their reasons have shifted over the years. Like
It's
what they said in 2019, then changed
yeah.
in 2020, and they talked about excess inventories. They talked about hiding vehicles. They talked about FSD was a sham. I mean, there's been so many reasons they've been short. I've lost track of them all. But to this day, the shorts have been batted back, and now the short interest on Tesla is very low. It's about 2.5, 3%. So it's the bulls have won. In my mind.
Yeah, and we'll talk about your future fund, long short fund. So you are not a stranger to shorts, and in fact, you're kind of balancing it out, which is interesting because you're playing both sides of electric vehicle game. We'll dive into that later, but let's level set a little bit, get folks up to speed. What is your Tesla price target? I know that as a kind of a portfolio manager, you are a quant. You actually have spreadsheets and you follow everything along. And frustratingly, for many people like me, you don't put line items in that I want you to put in already for products that are about to come. As a retail investor, I believe that those are coming, and that's why I invest before they come. You won't put them in until you're pretty sure you can line item it out. But you do have spreadsheets and you follow it. So tell us, you know, how you built that spreadsheet, what's in, what's out, and what's your price target.
Okay, well, first, let's just distinguish. I'm not a quant because quants they use factors. So anybody who's a
Sure,
fundamental
sure.
manager takes issue with being called a quant, and I'm
Fine.
actually a bottom up stock picker. I like to do research, and doing research, I think a 360-degree research. I like to talk to the customer. I like to talk to suppliers. I like to talk to competitors, and of course, I talk to the
Okay.
company. And that forms the basis of what an analyst does. And then, with that information, they go out and they build a model. And a model means many things, but I start with a market. So the market can be SAR, which is the standard selling rate. And I look at things globally, but I try to build it up by market. So I think of the world as US, Europe, China, and then rest of the world. And so I try to think of a selling rate in each of those markets. I try to come up with where the EV adoption is. And then I try to come up with Tesla's EV share. Now, I know that frustrates a lot of people because Elon's out there saying, well, there's no such thing as, the EV market, but it's just a modeling technique. And it's more precise to me to have two variables per market. So EV adoption and an EV share. If you multiply the two, you get overall share. If you want to just take market share, that's fine. But, to me, it's a more precise way of modeling, and that's why I do it the way I do it. And so, for instance, in like my current investment thesis, so just think about the model the way I just laid it out. We have EV adoption globally at about 10% last year. I have it going to 60% by 2030. So it's going from 10 to 60. And the SAR grows at about 2% a year. That's the selling rate. So it's just think about 80 million units of cars and light trucks per year, growing at 2 to 3% a year. And what you've seen over the last couple of years, and if EV adoption goes from 10 to 60, you can take that, figure out what is the growth rate associated with that. So take 60 divided by 10 and raise it to the 1/8 year without getting too quanty on you. But that's about 30% a year. So I got a 30% per year tailwind
Yep.
for Tesla on volume if they can just hold their EV share, which they've been doing. And so this year you saw that in the first quarter, and there are people who publish this data, but if you want EV volumes, EV-volumes publishes the data that I use. And so this year in the first quarter, I think Tesla's share of that EV business was about 21%, and then it dropped in the second quarter to about 19. It's going to drop in the third quarter because, as you know, they're refreshing Model 3. And so you're not, and Elon's actually warned about this. They're not going to produce as much in the third quarter, and they're not going to deliver as much. So EV share in the third quarter will probably drop into 16. So what I have modeled over the next couple of years is that EV share holds steady at about 18 to 19%, so that by 2030, I'm at, again, start with 80 million units times 60% times about 18%. I get about 10 million units looking at it that top-down perspective. And I'm trying to build it up by those major markets that I outlined before. I get about 10 million units by 2030. I know Elon's telling people 20, but if Tesla sold 20 million units in 2030, that would mean they have 25% share of the market, which is twice as much as the market leader today, who is Toyota. And so that math doesn't make sense to me. Nobody since Ford many years ago has had 20%, even 20% share of the market. So I'm happy with my forecast of 10 million by 2030. So back to your question about how do I get my price target, I put an average selling price on those units. I try to come up with an auto gross margin. That gives me my EV gross profits. I add in the way Tesla does it. They look at energy, and they look at, they call it services, but it's mostly charging stations. So I add revenues and profits for that. I back out R&D, SG&A. I try to forecast free cash flow so I can come up with an interest expense line. So then I come down to profit before taxes. I look at the tax rate based on the mix of different markets, how much is US, how much is Europe, how much is Asia. And I come up with a net income, and then I back out some of the um, variables that Tesla backs out to come up with what they call adjusted earnings. So like stock-based compensation gets backed out, but then it results in more shares. So what I wind up with is an adjusted earnings per share number. So for this year, I'm about 360. The street is about 340. For next year, we can talk about the differences if you want. I'm at 540. The street's at 470. And then by 2030, I'm up at $24. The street's at about, I want to say 14 or so. So on my $24 number, I try to figure out what is the PE at which Tesla should trade it in 2030. The PEs are based on future growth rates. They're not based on the industry in which you compete, unlike what the bears say. And so going forward from 2030 on, Tesla is not going to grow at the same rate it's growing from between now and 2030 because EV adoption is now 60%. So going from 10 to 60 is a lot of growth. Going from 60 to 100 is not as much growth. And so I use a PE of 30 times for 2030. I take $24 of earnings times 30, that's $720. And then I discount that back. Now, this is where, some of the real financial whizzes come at me because I use a discount rate of about 13% to discount it back. So cost of equity, if you want to think about it that way. And the way I do it is I start with the risk-free rate. So right now, the risk-free rate is over 4% today. It's the highest it's been since I want to say 2021. Um, but I use a 3.5% because you're supposed to look forward. So I'm trying to figure out where the 10 year is going to be over the next, 10 years or so. So I use a 3.5% discount rate. And then you look at the equity risk premium. So how much do equities return versus risk-free bonds? And normally it's about 6%. That's the average. But then I multiply that times Tesla's beta, because you have to look at things on a risk-adjusted basis. If I own Google, it doesn't have as much risk as Tesla. Tesla's beta is about 1.6. So I take 1.6 times 6, that's 9.6%. Add to my 3.5, that's 13.1%. That's the discount rate I use. I discount back from 2030 to today, and that's how I get $320 of price. And I've used that same methodology for years. And as long as I'm consistent with all
Mhm.
the stocks I own and consistent over time, I think it's a good process. And I don't ever want to be accused of just picking a price target out of thin air and saying, oh, well, because the stock price has gone up, I'm going to raise my price target. I always want to
Thank
give
you, Brad.
people, here's how I came up with my number.
Yeah,
And while I get yelled at a lot of times, I say, wow, your price target's way too low compared to
right.
Kathy Wood at ARK and so. It's like, well, it's my process and it works for me. And
Yeah,
it's what I do. So, as long as there's consistency and there's discipline, I feel like
yeah.
I'm doing a good job for my investors.
Right. Deep respect for you. I appreciate you walking me through all that. And like you and I have discussed before, you are actually, compared to the other institutional firms, you are a bull. And like you said, you're debating against shorts. Um, but when compared to retail investors and how we think, that's where we kind of debate a little bit. So I would be remiss if I don't say that your
Yeah,
10 million target for 2030 of cars sold by Tesla is ridiculously
low. Yeah,
low. Okay, of course I'm going to say that. I just have to say that, and I can explain all that why. Even your comment about Q3 this year being lower, you saw Alexandra Mertz break down the comments made by both Zach and Elon in the last earnings call, and they basically said very slight. There's going to be a week or two where they slow down production, but because of they improving the lines, it's going to bump back up again. So I'm not expecting a massive reduction, but that's okay. That's just this quarter,
I don't
not a big
expect massive.
deal.
Just to be clear, I
Yeah,
just expect
just
you'll dip a
maybe.
little bit.
Sure. That's just this quarter anyways. In my mind, it's not a big deal. And then of course, it seems like this is the EV market, and you have to decide what's going to happen to competitors and whether or not they're going to be able to, match. I mean, the reason Toyota is maxed out at 12 million is because you have 50 other automakers that are able to produce gas cars that they've been doing for 100 years, and they're basically now parity in terms of production. They've gone through the 70s, 80s of the quality wars. This is not the case with EVs. We're at the very beginning, and we're seeing a lot of people not be able to catch up. But the expansion of the TAM, right? Now we got Cybertruck, we've got this compact car, and
Right.
you can't just think sitting still. You're basically looking at where they're at today and then mapping out to the future. You got to that's where you and I debate. You need to plan what's going to happen every year, additional new products, additional energy and robots and all that stuff. You won't add them until maybe a couple of years from now. So your numbers will change as the years go on.
Yeah.
So the interesting the comment I made was that you are basically a bull compared to the institutional firms, and we really appreciate as Tesla retail investors to get your feedback and the way you think, because you share that you were the CEO of massive institutional firm funds. So can you tell me a little bit, how do institutional firms think? How do they look at Tesla today? And like, I guess the question is, we're seeing more and more of them buying in now, especially after getting
S&P
the credit.
500,
Yeah, and yeah, that one and the investment grade credit
investment
rating.
grade.
But
Yeah.
yeah, tell me though, what is the biggest concern they have today? That why if for those who haven't yet, why aren't they piling in at this point?
Yeah. Well, look, and just be aware that institutions is a broad
Yeah,
category. And so institutions can be the sell side community and they put out estimates. Remember, their job is to generate commissions. They're not really
right.
picking stocks per se. If you think about what they do is they try to get buy side clients to pay them commissions. And so they try to add value through their research and through their client service. And so, when I talk about institutions, it's both the sell side community, because you got to compare your estimates to them because those are who publish. And then, the buy side community are people like Fidelity and Capital and T. Rowe and Ron Barron and Kathy Wood ourselves. And so, let's start with the sell side. So I'm more bullish than most of the sell side analysts. My price target is higher, and my estimates are higher. So just as an example, I'm at 540 in earnings for next year, and I have 2.8 million in volume. So I'm looking for 53% volume growth for 2024. And to your point, it's because CyberTruck is coming. And I can look at the difference in my numbers because I can see Bloomberg. I pay $2,000. People ask me, well, where do you get all those pretty charts? Well, you pay $2,000 a month to Bloomberg, and you can have whatever pretty charts you want. But I can see what the consensus numbers are pretty much by line item. So I can see what they want, what they think is going to happen in energy. I can see how much units they have. And so where I'm different from the street next year is I have much higher volumes than the street does, because I remember what happened in 2021 when the Model Y came out. You had a new product, it's new news to the category. And my prior life, Herbert, I was a product manager for J&J on the Tylenol business, so I understand
What?
branding. Yeah, I worked for
I
J&J.
did not see that in my research. You were, by the
Well,
way,
there
to
you
tell
go.
everybody you're Harvard MBA, you're a Wharton in economics. I didn't see
So I
product
bring it up.
manager for J&J. Come on.
Well, but I want people to understand that I've actually worked for a living. I haven't just been a
Yeah.
financial analyst my whole life. I started as a product manager at J&J on their flagship Tylenol business, because it was the dream job that I always wanted. I always liked consumer, and when I got it, I was bored. It was just a very, slow moving business, and I had a big mouth then, and I would say we should do this with the packaging, and this with the advertising, and this with promotions, and people say, well, you've only been here for 6 months, Gareth, so take a pill. You know, I wasn't
Take
going
on
to
your
take a
pills.
pill. So anyway, I gravitated to Wall Street over the next 3 or 4 years. A guy that I had worked with between my 2 years of business school found me. And by that time, I had gone to work for Trammell Crow as a real estate manager. I was managing a whole bunch of properties for Trammell Crow, big real estate developer out in Scottsdale, Arizona. And it was a brand management type of job. You had to basically convince 20 somethings and 30 somethings why they should live at these high end properties and pay rents that were higher than everybody else. And the guy who hired me lived in San Francisco, and he wanted product managers. So anyway, long story short, guy that I'd worked for between my 2 years business school found me there and said, "Hey, we have an opening at Sanford Bernstein, great research shop, and you were pretty good at research. So why don't you come in and interview it?" And I said, "Well, what does it pay?" He said, "Well, it doesn't pay that much." I was making pretty good money at the time. And long story short, they paid me about a third of what I was making, but said, "Look, the upside is it's huge. If you're right and you get ranked as an analyst, you can make multiples of that," which turned out to be true. So back to the buy side and the institutional community, so the sell side does what it does. Their job is to generate commissions. The more commissions they generate, the more money they make. And you always have to remember that their job is not to pick stocks. They should be right, but that is not the number one criteria that drives their dollars. If you think about Adam Jonas at Morgan Stanley, he's not, in my opinion, he's not the best analyst out there, but he's very merchandisable and he generates a ton of commissions and he asks for the order, and so he makes a decent amount of money. The guy that people pay attention to is Tony Sacconaghi. He's the number
Mhm.
one Apple analyst. He's the biggest bear. People ask me about you know Johnson, who
Gordon.
I don't even, nobody listens to him. He's
Yeah.
out there. But
Yeah.
Tony Sacconaghi is a real player. The hedge funds listen to him. He's been bearish on Tesla forever, and so you have to know what he's thinking. So at least you can when something happens, you can at least say, well, here's the way the bears think. So that's why I pay so much attention to Tony and other bears, because I want to basically knock down their arguments. And I think if you're a bull, you have to be able to do that. You have to understand what they're talking about. So the sell side is out there. There's 50 analysts, I think. Let me see what the ratio is of buys versus holds versus sells. Right now, I'll tell you what it is on my Bloomberg. It is 40% have buys on the stock, 40% have holds, and
Mhm.
20% have sells. So that's
Good.
actually a more even distribution. Like if you type in Apple,
Yeah.
you're going to see, let's see, Apple's got same, about 50 analysts covered, 67% buys, 25% holds, 8% sells. And so Tesla has a more skeptical contingent on the sell side. And I think, so back to your question, what is it that the sell side, and then we'll talk about buy side institutions in a minute, is most skeptical about? I think they're skeptical of Elon. As much as, we all love Elon, the brilliant but the crazy, I think they worry that, he doesn't, he's a great engineer, he's a great product guy, but he doesn't always make the best marketing decisions. And so they worry, is
What? Okay.
he going to blow up the company again?
Mm.
The way, it's not that the way they blew it up last year, but he cut prices and the stock fell 55% in the fourth quarter versus NASDAQ was flat, and anybody who owned Tesla got crushed. And so the worry that people have is, is he going to do other silly things? Like, remember, he had this idea that you should only have a yoke steering wheel on a Model S or Model X. And we were out there very aggressive saying, that's dumb. You should give customers a choice. They said, nope, I'm just going to give them one. And, he turned out to be the wrong decision, and he went to offering choice over time. And look, we could talk about it later. He's changed the Twitter brand from Twitter to X, which I have very strong opinions about, and I know a lot of people in the advertising world do. But this is what he does, and he's how do you bet against a guy who's the richest guy in the world, and he's right more than 65% of the time? He's usually right. He usually gets things right. So so the challenge with Tesla is it's very dependent on Elon. There's very big key man risk. It's not like there's a well-known number two or a bench who's going to take over if he were to get hit by the proverbial truck. And so that's probably the biggest reason people are struggle with it. The second biggest that he's one guy and it's key man risk. The second biggest reason I think institutions worry about Tesla is because now they don't have the playing field to themselves. And there's always been competition coming, right? We've always heard about Chevy Bolt and Nissan Leaf and other EVs coming, but those have been junk. They don't it's not like the EQS from Mercedes or Rivian or other very high quality EVs that are coming out now. And so a lot of institutions say, well, when they had the whole field to themselves, you could bank on their earnings growing up at 50% a year, volumes go up 50% a year. But now you can't bank on it. Maybe they will, and I still think you're going to get volume growth of 35% a year based on my models, and I think you can get earnings close to 40% a year. But a lot of institutions are worrying that with so much competition coming in, and this is Tony Sacconotti's bear thesis, that they've never faced competition as they're going to face over the next couple of years at the high end. And so that's something people worry about. I think we just have to get through it. I think the third thing that people worry about is he's putting so much of his time and effort in FSD, and he says it every year. The car's going to drive itself at the end of the year. And people like me, it's not that we're skeptical. I think he'll get there. I just think others will get there as well. And I look at a lot of different companies. I own Baidu in China, which has a lot more hardware in their stack, and they're already at level 4, and they're in 4 cities where they're licensed to offer robotaxi rides. Um, and if they can do it, others can do it, right? So I get the point that nobody's got as many miles and experience as Tesla. Nobody has the compute Tesla has. Nobody has the talent Tesla has. But people can catch up, and I know you disagree with me on this. And so I think that's the other worry that people have. These putting a lot of time and attention to that, and if everybody gets there around the same time, where does that leave you? And I think that's a worry that some people have. But I still like Tesla, and I'm still a bull. It's still our number 2 position. I love arguing about it, and I love going after bears who say the competition's coming, because the competition's been coming ever since I've owned it, and it just hasn't come, right?
Thank you.
So
Well, I mean, that's okay. Okay.
the
Well,
Chevy Bolt
I
is coming back. I read something this morning that
yes,
said
it's coming
it's
back. It's on a
kind of
new
like
the
new code.
Altium. It's on the Altium platform. I have a theory of why they pulled it back. They want to get the loan from the government. That's my theory.
Uh,
Just like Ford got
okay,
9 billion. I think
okay,
that they were playing for that. That's just my theory. Anyways,
that's possible.
appreciate you walking me through the 3 main things why the institutional firms. Of course, I completely disagree with all of them.
Yeah.
Maybe not. This is not the time for me to go in depth about it because I just really wanted to know what they're thinking, and that's a fact. That is how they're thinking about it. And of course, you and I disagree about FSD. We disagree about a lot of things, but I still, again, as I say, I always appreciate that you're at least the leader of these institutional, and they listen to you. I mean, you guys talk to each other regularly, and I
Oh, sure,
appreciate
of
that,
course.
right? Yeah, tell
Yeah.
me about that.
Well, here's
You
the
got
thing.
phone
So
calls from each other all the time, right? And
well,
you're imparting knowledge, right? And that's why our retail is trying to change you so that you will
yeah,
change your
I
language to them.
I can't, and that's silly. I mean, if you're a portfolio manager at Fidelity, I was just up at Fidelity 2 weeks ago. He'll listen to me because he respects me, from my
Yeah.
analyst days, but he's not going to change his mind because they do as much, if not more, research than I do, and they have a view of, and they follow a lot of companies, and what I think a lot of retail investors miss is they're looking at Tesla in a vacuum, and a lot of these PMs they're looking at other industries where similar things have played out, where new
No.
competitors show up, and
Okay.
they say, okay, well, here's what's happened in other industries, and I hear that all the time. It's like, well, in this industry or that industry, I saw this dynamic happen, and look, that they're entitled to that. And, think about what happened last year. Okay, there was a lot of debate when they started discounting in China, which was the fourth quarter, about whether Tesla was going to have to cut prices. And shame on me for not getting out of the stock when it was 350 because it went all the way to 108. And you say, well, a retail investor, they don't have to do that. Well, they should have when you think about it, because you could have bought back three times as much at 108 if you got back in. You could have three times as much stock if you sold 350 and then when it hit 108, you buy it back. You could have three times as many
Yeah.
shares.
Okay. Well, I never took you as somebody who times the market, although you do
I
seem to
don't.
be timing the market on a quarterly basis because no one can time the market unless you think that,
If you see
I mean,
fundamentals
you
change, Herbert, if you see fundamentals, and that was a big
well,
change that they were going to have to cut prices, and they did, and that was something that a lot of people got right. I didn't,
well, the
and
fundamentals that changed was the economy. The economy hammered everybody,
oh, come
and
on, it's not the economy.
Apple and Tesla were the
Yeah,
last to fall in September, October of 2022.
it's not the economy. The
Everybody else
economy never
fell.
weakened, Herbert. The economy never weakened. What are you
The
talking about? The
economy,
economy?
the interest rates rose so high, and this is a high asset vehicle that people can't afford. Elon has talked about this all the time, that it changes the price of the product just because the interest rates went up, because vehicles are purchased through leases and loans and so forth. So interest rates go up, their monthlies go up, they can't afford it, and so they have to cut the prices to do that. And then of course there's the long-term strategy of Tesla that, forego that for growth, get as many cars out there, gain the market share later. That strategy, which I completely agree with, and it's a short-term hit. But if timing it, if people can time the market, then they do well. But most people can't time the market, and so you just hold strong. And and by the way, the other comment I want to make is that us retail investors are different because we really study this. We know everything that's going on. Don't the institutional know that is the competition coming or not? Do they know the profitability of all these companies? Do they know everything that's happening to them and they're struggling?
It
We
doesn't
have
matter,
not had
Herbert. You're
anybody.
you're missing the point, okay? When you
Yeah,
guys say, "Well, they're losing money on it," well, of course they are. They're not making that many
startups.
vehicles. And if you're GM or you're Ford, you got huge resources behind you. So they know, to their credit, they have to be in the EV business. The whole world is going to be EV by 2030. They have no choice but to lose money on every vehicle and to just keep, losing money and hope that they can build volume. So of course they know that, but that's not what's driving the debate. If Ford is losing money on every product, but they keep investing in it and they keep advertising it, at some point they're going to grow their volumes to be such a point, just like Tesla did, where they'll break even. It's not like Tesla's going to put them out of business, right? Unless you believe that. You really think Tesla's going to put Ford out of business or GM out of business?
I do. I do
Wow.
believe that Ford and GM will not be the Ford and GM that they are today in 5 years. They will survive because of bailouts, which they're getting the loans. But
That's true.
it's
That's
it's
true.
so if you remember the comment you just made, which is some of the institutions look at other industries. I can't think of a single other industry where an incumbent of a legacy technology survived the transition to a brand new technological change. The EV change, a software driven car, and then eventually robotaxi. Those two things are just not in the wheelhouse of these old legacy automakers. And so to think that a legacy automaker, oh, it's just a car. I built a car. I can build this new car. It's just a different brand. That's not the case here. It's
You
like a
don't think like
whole.
that,
It's like
Herbert. You're being naive. Okay, I'm sorry. You're being
oh, I
naive.
hate,
That's
love that
not
when
the
people
way.
call me that. Love it.
No, because think about it. Mary Barra and Jim Farley are not just thinking, okay, I built the car the way I always built the car, and I'll just build another car. That's not the way they're thinking. They're investing a ton of money in autonomy. Think about Cruise. Okay, Cruise is owned by GM, right? It may not be the way you would go or the way that Tesla would go to geofence an area, but they're building out an autonomous vehicle. I think you should look at the Chinese makers because they seem
I
to
do.
have the
Yep.
most momentum behind autonomy and in EVs, and they're backed by the Chinese government. The Chinese government is helping them, okay, which that's going to continue to happen. And so, if you look at somebody like Baidu, they have level 4 autonomy. They have the Apollo Go cars in 4 different cities in China, each with 10 million residents. Right? You can't just say, "Oh, well, nobody else can do what Tesla does," because other people aren't. I think that's where the disconnect is. Retail
No,
investors
no,
is
no.
saying
So
nobody
it's
else can
yeah.
do what Tesla does, and that's
Well,
just foolish.
yeah, okay. Well, since we're going to talk about FSD, then I mean, I do have to respond because if I don't, then it's
Sure,
like
you
I don't
can.
want the people to not hear. I don't want to necessarily debate you and
Yeah.
end to end here, but for example, I mean, we do know that Cruise announced that they're now expanding to Nashville. They're now in 7 cities. Waymo just announced that they're going to be showing up in Austin. So these come, and then the Chinese ones. By the way, just to fill this out, some news that happened today and last night was Xiaopeng, the director of the lead of the autonomous vehicle, left. Most likely because of the partnership between Xiaopeng and Volkswagen that happened. Very likely, it's not a coincidence. And then the Li Auto, they announced that they're not going to. Well, it's not official, but there's rumors that they're going to no longer do lidar. They're going to switch to vision only. So any company that's doing lidar, like Waymo and Cruise, they're shit out of luck, right? And so but let's talk about that a little bit. So they are expanding. So robotaxi is available in these cities, just like you said. So when you say that, Tesla's not going to be the only one, yeah, I agree with you. That's the case today. In fact, these guys are the only ones doing it now. But what happens when Tesla turns it on, let's say in Austin, and they have 20,000 Teslas able to do point to point, not restricted by geofence. And because they have so many cars, they're able to price their because they are able to price much lower, undercut it. Will Waymo and Cruise still survive at that environment? Maybe, but they'll have a very small market share at that point because in order for them to expand, how much money? By the way, they're losing a ton of money, right? You got to tell me their profitability. They're not making any money. And by the way, these are driven by humans, right? So it's autonomy, but then when they need to, there's a human that's actually going to pull it out of the case, right? They're going to do that kind of stuff. So it's crippled, and it's only during nighttime, all those kind of things. So they can't afford it because the cost of them to deliver this. And so while they're expanding cities, it's not because they've solved the business model and now they're selling direct to consumer and they're making huge profits. This is the difference between the business model, and I go with the business model it's unencumbered versus one that is just for show. So by show, it looks like that they're there, but it's not an actual business. So again, don't necessarily want to go too long on this, but yeah.
I'm just
So
saying,
we
don't
fundamentally disagree, right?
assume that
Yeah,
Tesla's
you
going to be the
believe
only.
that it's going to be you think that it's a commodity. FSD is a commodity,
It's not
and
a commodity. It's not a commodity. It's just the Tesla
well,
has a head start. They have a couple of years
yeah,
a head start, but others will catch up. That doesn't mean it's a commodity.
okay,
But look, I
okay,
agree with you. And so go back to the basic fundamentals. Tesla is going to sell more Teslas once it achieves what I call level 4 autonomy, where the car drives itself. Okay. But I'm not going to double count it and then say, okay, on top of that, $15,000 for FSD or $199 a month. On top of that, I'm going to count even more for licensing as other OEMs decide they're going to actually have Tesla, do their hardware and software and convert their cars into EVs. Okay, I, that to me is a double count, right? So once I go down that path, I think I'm because I'm already counting those cars that people are going to buy Teslas. They're going to spend $15,000. They're going to spend $199 a month. I'm not going to then double count it again in somewhere else. So that's the challenge I have. I'm sorry. My phone's right. That's the challenge I have with some of the Bulls math, that they're double counting this FSD, and that's when people say, "Well, I've got $1,000 price target, of which 200 comes from this, and another 200 comes from FSD, and another 200 comes from ride hailing, and another 200 comes from and a lot of it's double counted, and that's the challenge I have with a lot of the
Mhm.
bulls that post their stuff out there.
Hey there, thank you for joining me. If you can, please consider supporting this channel so I can keep it going. It's a lot of work arranging all these amazing interviews. One of the easiest ways is just to click that join button and become a member of the channel. Thank you very much. Let's get brighter.
So
Okay, well, I think some of that's fair. So, can we talk a little bit about your catalyst? You're known for your catalyst. I'm known for the milestone list. So we kind of we gotta share that as our contribution to the Tesla community. But your catalysts are pretty well done. Very appreciate them so much because you look at kind of the overall things that you think will impact the stock near term. So why don't you walk me through? I saw the one that you published this morning. Tell me what you're thinking is going to impact the stock in the next 6 months. Year.
Okay, so the number one thing that institutions are looking for is that margins have troughed. So gross margins. So gross margins last year were around 26. They hit 30 in the first quarter. I think on average last year they were 26. They went to 19 in the first quarter. They hit 18 in the second quarter. And what people were hoping for on the earnings call was that Zach and Elon said, "Okay, this is the bottom. They're not going to get any worse than this." But they didn't. They didn't take that bait. And in fact, they said, I want to say the opposite, but they didn't want to assure people that margins couldn't fall further. That's when you heard Elon say, "Well, if the Fed takes interest rates up again, we may have to cut prices again to keep the payments the same," and that freaked everybody out. And that's why the stock was down 10%. I'm still holding on to the thesis that margins have troughed. And so the first thing people want to see as a catalyst when you get to third quarter, that margins haven't gotten any worse. Okay. 18 is fine. I think the street's looking for about 18 and a half. But that's a catalyst, if we can. And so, look, you could cut prices if it's offset by cost of goods, but that's not what's happened so far. They've cut prices in advance of cost of goods reductions, right? Otherwise, margins couldn't go from 26 to 18, right? So that's the first
Okay.
catalyst people are looking for. The second catalyst I'm looking for is CyberTruck. CyberTruck is going to be a rolling billboard. Everybody's going to see it. They're going to say, "Wow, that's really amazing." And they're going to go to the website, and they're going to go to the store, and they may not buy a Cybertruck. They may buy a revamped Model 3, or they may buy a Model Y. But it'll spark interest the entire Tesla franchise. And that's what happened in 2020 and 21. Volume growth in 2020 was 36. 21 it was 87 because of Model Y. And it wasn't just Model Y. There was very little cannibalization of Model 3, which is what all the bears were banking on. There was actually some cannibalization of Model X, but it really ignited the whole franchise. And that to me is a very huge catalyst that the bears are missing. The third catalyst is what we're talking about today, is the refresh Model 3. I think, yeah, you're going to see a little bit fewer Model 3s sold, until you get to the point where they launch them. But I think they'll make it up because it'll be a new car. It'll be a whole different look. It'll look more like a Model S. It's going to have a grille. It's going to be, much sleeker looking and much more updated. The headlights, the taillights will be different. And so I'm hopeful that they can get that out pretty quick. We keep hearing August 14th, they're going to shut down the factory in Shanghai for Model 3. But I'm hopeful that, they can get the new Model 3 up and running pretty quickly so you don't have that much down volume. But even if they do for the third quarter, and this is back to what I said originally, that volume could be off a little bit in the third quarter, they can explain it away, and the institutions will say, "Okay, that's fine." So that's a catalyst, a refreshed Model 3, because they haven't ever refreshed the car. And then the fourth catalyst is the $7,500 credit in the U.S. that they're getting this year as a
Yep.
tax credit.
January
That
1st.
becomes
Yep.
a off invoice, so it goes into your loan amount when you finance the car. That'll be huge. And
January
then,
1st.
yeah, the last catalyst I think is when FSD gets to be level 4, and this means
This year.
Tesla has to take the liability associated with calling it level 4, which they
Mhm.
don't today. I think that'll sell more Teslas. When I look at California, there's different levels of we'll call it autonomy licensing, and there's 4 right now that are deployment. They have deployment licenses. There's 7 that have driverless autonomy. And then there's like 40 that have what Tesla has, which is so-called level 2. To be in the first two categories, you got to be level 4 or level 5.
Yeah.
And so when they get to
Okay.
level 4, that'll be helpful. That they'll sell more Teslas.
Perfect. Thank you for that. I do want to get to your future fund. I want to deep dive in that as well as in the last 5 minutes we have here. But thank you for that, Gary. I think you really get the Cybertruck, and I think you get the Model 3 Highland. I think the Model 3 Highland, people forget that the sedan is the second largest category of cars globally. Maybe not in the US, but globally, it's a massive. And the Model 3 Highland will separate the price point and have a much more clear segmentation separated from the Model Y and in between the compact. And so between that market share and between the Cybertruck and then the robotaxi, yeah, you bet we're going to hit over 10 million, Gary. But okay,
Well, also the
so
$25,000 vehicle, which is, we didn't even
right,
talk about that. That's going to happen in
exactly. So
2020.
what do you want to talk about? You got the future fund, which is what you are, what was your bread and butter, and then you launched a new short, long, high conviction stock fund ETF. So tell me first of all, I love that Tesla is number two. It should be your number one, but you think Google's number one.
Google's worked for us. Look, over the last year, Tesla's actually, it's done well this year, but it's down 17%. Nasdaq's up 19%. So, it hasn't been, over the last year, it's not been a great stock for us, and it's
Right.
because they took prices down in the fourth quarter.
Correct.
And, thank God we held on and, told people to bug off when they were giving us a hard time about owning it. But,
Mhm.
Google's been a great performer, as, has Microsoft, as has Apple. So let me just tell you a little bit about the Future Fund. We started this with the view that ETFs were the future, active ETFs. People like the transparency of ETFs. Every night you could see what we're doing. If we make a change, like when we added Baidu, people DM me and say, well, why do you own it? Tell me why you like it.
Mhm.
Or if we get
Mhm.
out of a stock, people want to know that. And I think that's the future. Investors today want to know what they own, and they want to see every night. And Kathy Woods figured this out a long time ago.
Yeah.
They want to know what's in the portfolio and what's changed. So we're transparent, but we are high conviction. You won't see closet indexing here. We own 30 names. Again, we build models. We get conviction about each of these names. We do our research. We're bottom up stock pickers. And so when we own a name, we have an upside downside for each. We have a price target for each. We can articulate how we get there. And we want to do what we call deep research on each of these names. So you go through the first 30 names, and we can tell you why we own each one of them, and what our price target is going to be. Um, and I think, look, what I like about it is, because we know the names, nobody, when people think about it, they're not thinking about us as just, trying to, get to an index. When you think about long short, which we just added about a month ago, we're trying to get to an S&P type return. There you go, with about half the risk. And so we can add alpha on the short side. So you look at our number one short position, it's Toyota. Toyota's down about 3% today. And the reason we don't like Toyota, the reason we're short is because they have no EV presence. They're less than 1% of their volume is EVs, and they really have not gotten anywhere, trying to build an EV business. And it's very funny watching the industry. They've gone from let's create entirely new brands. So you think about Polestar was spun out of Volvo, and rather than just called Volvo EVs, which would have been smarter, they try to create a whole new brand. Um, and I think what the industry has learned, that's not the right strategy. The right strategy is to take an existing brand. So take Porsche. Porsche's largest selling product is the Macan. It's a smaller SUV, and launch a Macan EV. And then the Cayenne EV comes next, rather than create a whole new brand called Taycan. And so I think that, they're learning, the industry is learning that that's the right way to do it. And as the industry learns, and look, they're going to spend money on advertising. They're going to be behind Tesla, because if you drive, for instance, a Ford Mach-E, which I have, or Volkswagen ID4, they just feel buggy. They don't feel, like a Tesla does, is sleek. But when you drive an EQS, and there's been a couple of videos, they're very quiet, they're very smooth. And a lot of people say it's a great car, but it's $100,000 car. So I do think there's competition out there. Can they compete with Tesla? The jury's out. I'm betting that Tesla, because they have Cybertruck coming, because they're going down the cost curve with the next gen, we'll call the Model 2 in 2025, because they're refurbishing the Model 3. They can, and because of FSD getting to level 4, which they are ahead of everybody, I grant you that. I think they can continue to grow their EV share, and that's why we own it as our second largest position. When people go EV, they're going to naturally, just like in the 1960s, when somebody decided to buy a computer, they would go with IBM because it was a safe choice. What's funny about Tesla, I had this debate with an investor last week. Ubiquity is a dual-edged sword. It's a stamp of approval for somebody who has never bought an EV, right? So because a lot of people own them and they see them and they trust that they've done their homework, they buy them. But ubiquity is also a negative, and people don't always want to drive the same thing their neighbor's driving. So
Yeah.
as we at Future Fund think about this stuff, we try to think about, number one, how does the consumer think, and why do they buy one brand versus another? And if there's going to be competition showing up, can Tesla, for instance, withstand the competition? Same thing with Google. When Google has to deal with, ChatGPT being part of Microsoft Bing, Google is entrenched, and they will, in search, they own 90% share. Will they be able to withstand what might potentially be a better product for a couple of years? And the answer we have is yes. So, that's the type of research we do. And look, it's worked for us. Our performance this year, if you look at like Morningstar categories, you'll see that we're top quartile. We're beating the Russell All Cap Growth, which is our benchmark, by about 700 basis points. In this type of environment, which is a growth environment, and just to give you a little bit of 10-second of macro, when the Fed starts to pivot, which we believe it will later this year,
Correct.
as long as you don't have a recession, you got to believe that the Fed
Later
can
this
navigate
year.
so-called
You're the
soft
first I've
landing.
heard that. I believe that too, but you're the first I've heard say later
Okay.
pivot later this year.
If
Not
you
pause,
believe
pivot.
if you believe the Fed can navigate a soft landing, so land the economy at zero growth and not go below it, which is hard, growth will do better than value. And that's what you've seen historically, that when the Fed goes from a tight monetary policy to accommodative monetary policy, as long as you can avoid a recession, growth will do better than value. You should
Yep,
be investing more in growth stocks than in value stocks.
we should be. Yep, agreed. Okay, well, Gary, thank you so much. That was fun. Love you. I really do. I like the way you think. There's a lot of things that frustrate us.
Yeah,
We
that's okay.
debate.
So it
We'll
makes a
continue
debate. As
those
long as it's
debates.
respectful. As long as it's respectful,
But
people should
and
debate.
and we have to remind ourselves that 90% of everything you actually do agree with everything. Just those, remaining things. But thank you so much, Gary. That was fun. You're on Twitter. Very, follow him. One of the few folks who has the experience of institutional firms and knows what they're doing. At Gary Black00. Check out the website at www.thefuturefund. And you just saw two ETFs, the Future Fund, the bread and butter, and now his new one, the long and short fund. It looks like you're long 29 and you're short 16, and you balance the two out. Wonderful.
We
Hopefully you
generally run
enjoyed that
about
too,
60%
Gary.
net. 60% net long is kind of our sweet spot, for kind of
Yeah.
where we are today. So again, in the bull market, we're not going to do as
Yeah.
well as ARK, but in the bear market, we're going to protect you much better. And look, we believe
Gotcha.
as the Fed pivots, it's going to be choppy. And if you believe that it's going to be choppy the next 12 to 18 months, you should be hedging a little bit.
Yeah. Gotcha. Makes sense. Thanks, Gary. Appreciate you.
Okay, Herbert. Good to see
Okay,
you.
bye bye.
Thank you.